Is the U.S. economy on the brink of a significant downturn? From potential Fed rate cuts and unstable housing markets to unprecedented banking stress tests and retail declines, we've got the expert analysis you need. Learn why the ISM index is causing alarm and how America's income crisis is reshaping the future. Don't miss out. Subscribe now to stay ahead of these critical financial changes. Today, on Financial Analysis in Review, we will summarize the following videos. From Danielle DiMartino Booth, we have The Fed Can Cut Rates in September, and It Will Not Be Political. DiMartino Booth with Blake Morrow. From Danielle DiMartino Booth, we have How Will Banks Hold Up Against Stress Test That Mimics 2008 Financial Crisis? From Game of Trades, we have The Moment We've All Been Waiting For Has Arrived. From EPB Research, we have America's Income Crisis, How It's Triggering a Collapse in Birth Rates. From Mott Capital's Market Chronicles, we have Global Market Divergences Are Growing Wider. From Eurodollar University, we have Warning, Walgreens reports people have suddenly stopped coming. Welcome back to Danielle DiMartino Booth's channel. In today's episode, we have the pleasure of hearing from Danielle DiMartino Booth herself. As the CEO and Chief Strategist at QI Research, formerly known as Quill Intelligence, Danielle brings a wealth of knowledge about macroeconomic trends, financial markets, and the Federal Reserve's policies. The core thesis of this video is examining the potential for the Federal Reserve to cut interest rates in September, driven by economic data and not influenced by political considerations. Danielle provides an in-depth look at consumer confidence, the housing market, and unemployment trends to argue that such a rate cut is not only possible, but likely, given the economic conditions and Jerome Powell's non-political approach to monetary policy. Here are the key points discussed by Danielle DiMartino Booth. Economic data insights. The Case-Shiller House Price Index and Conference Board consumer confidence data show a mixed economic environment. Housing prices reflect past trends, but rising inventory points to future disinflation risk. Consumer confidence is relatively stable, but most Americans feel we are already in a recession, although actual widespread job losses have not yet materialized. Housing market trends. Danielle notes that home price data usually lags and reflects the market's condition from 3 months prior. Current data signals weakening and rising inventory levels akin to 2019. A rapid increase in inventory could lead to falling home prices and shelter disinflation in the near future. Unemployment trends. Unemployment has ticked up to 4%, and jobless claims are approaching levels seen last summer. Unusual seasonal layoff patterns suggest underlying economic weakness, pointing to broader systemic issues. Danielle DiMartino Booth made the following predictions. Federal Reserve rate cut in September. Danielle argues that Jerome Powell's approach to economic data is non-political, making a rate cut in September plausible if unemployment rates show significant increases. She compares this period to early 2008, when gradual rises in unemployment eventually led to rapid economic weakening, prompting rate cuts. Increased layoffs and economic weakening. Danielle predicts that further layoffs are imminent, especially during the next earnings season, as CEO and CFO confidence remains low. This trend could accelerate unemployment rates, leading to economic conditions that justify a rate cut. Danielle DiMartino Booth concludes that a September rate cut by the Fed is feasible, driven by deteriorating economic indicators rather than political motives. She advises caution in the financial markets, especially for those nearing retirement, and emphasizes the importance of adapting investment strategies based on current economic realities. She invites viewers to follow her insights on her Substack page for ongoing analysis. Welcome to the Danielle DiMartino Booth YouTube channel. Today, we're diving into a critical and timely topic. How will banks hold up against stress tests designed to mimic the 2008 financial crisis? Our guest, Danielle DiMartino Booth, is a former Federal Reserve advisor and the current CEO of Quill Intelligence. She brings a wealth of experience and knowledge to the table, providing unique insights into the banking sector and the broader economic landscape. The core thesis of this video centers on the Federal Reserve's annual stress tests for the country's largest banks and how these institutions might fare under a hypothetical severe global recession scenario. Danielle argues that while the largest banks are likely to pass due to their aggressive loss recognition practices, smaller and mid-sized banks may face significant challenges, particularly in their credit card loan books. Here are the key points discussed by Danielle DiMartino Booth. Importance of stress tests. Stress tests were introduced post-2008 financial crisis to evaluate banks' resilience under extreme economic conditions. The 2023 stress tests involve a hypothetical scenario with a 10% unemployment rate, a 36% drop in housing prices, and a 40% decline in commercial real estate prices. Banks' readiness. Large banks have been proactive in recognizing losses and writing off problematic loans, positioning them well to pass the stress tests. Mid-size and smaller banks may struggle due to less aggressive loss recognition and insufficient risk management. Credit card loans. Banks have expanded their credit card loan books despite a weakening U.S. consumer base and the unreported impact of buy now, pay later (BNPL) schemes. This aggressive growth in credit card loans raises concerns about potential defaults, particularly since BNPL debt is not reflected in traditional credit metrics. Living wills. Large banks also undergo living will exercises to test their ability to unwind Wall Street contracts in a crisis. 4 of the 8 largest banks failed these exercises, highlighting insufficient preparedness for rapid unwinding amid financial turmoil. Danielle DiMartino Booth made the following predictions. Stress test outcomes. Danielle predicts that the largest banks will likely pass the stress tests owing to their proactive measures. Smaller banks, however, may face adverse results, indicating vulnerabilities that could affect their stability. Future risks. She emphasizes the importance of accounting for modern risks like BNPL and global interconnectedness, which were not factors during past crises but are now pivotal. Danielle DiMartino Booth concludes that while the biggest banks might sail through this year's stress tests, the system is not without vulnerabilities. Mid-size and smaller banks could reveal cracks, especially in their credit card loan portfolios. The evolving financial landscape requires regulators and banks alike to reassess and address contemporary risks. A call to action for viewers: stay informed, scrutinize the robustness of your financial institutions, and be cautious in navigating today's economic climate. Welcome to Game of Trades. Today we're diving into the intriguing complexities of the current U.S. economic landscape. Our focus will be on a major economic indicator that recently signaled a potential slowdown in activity, marking a significant pivot from the recovery we expected in 2023. The core thesis of the video is that while economic indicators like the ISM New Orders Index suggest the U.S. economy is heading towards a downturn, the stock market has been defying these signals by consistently reaching new all-time highs. This paradox creates a split among Americans on whether the economy is truly in recession. Here are the key points discussed by unspecified host from Game of Trades. ISM New Orders Index. The ISM New Orders Index has plunged to its lowest level in over a year, a sign typically associated with economic downturns like those of 2008 and 2001. While GDP growth is at 3%, reflecting economic expansion, the ISM index may indicate an upcoming contraction. Historically, this index forecasts economic shifts ahead of GDP changes. Stock market behavior. Despite the grim ISM index, the S&P 500 index has been soaring, consistently making new all-time highs over the last 2 years. This disconnect between the market and economic indicators has caused differing opinions on whether the U.S. is in a recession. Best case versus worst case scenarios. In the best case scenario, the economy struggles around the current levels until June 2025, after which it begins to recover. In the worst case scenario, the U.S. economy weakens substantially over the next year, leading to a full-blown recession. Economic and market predictions. The main narrative since November 2023 has been to take advantage of the strong market for successful trades, while being cautious of potential recession signs. Unspecified host from Game of Trades made the following predictions. Economic downturn by June 2025. Interest rates predict a continued weakening of the U.S. economy until June 2025. The ISM New Orders Index may dip below recession levels, similar to 2001, 2008, and 2020, leading to significant market moves down. Stock market trends. If the economy mirrors the best-case scenario of 1995, the S&P 500 could enter a multi-year bull market. However, ongoing weakening suggests a more pessimistic outlook. The host concludes that while the ISM New Orders Index points towards an economic downturn, the stock market's robust performance presents a complex picture. Investors should prepare for potential volatility by considering both best and worst-case scenarios. Stay tuned with Game of Trades for trading strategies tailored to navigate these uncertain times. On this episode of EPB Research, we dive into the startling connection between America's ongoing income crisis and its impact on declining birth rates. Our guest, an expert financial analyst from EPB Research, unpacks the factors behind sluggish consumer confidence despite rising job numbers and stock markets, and how this economic trend is reshaping American demographics. The core thesis of this video is that deteriorating real income levels in America have triggered a significant decline in birth rates, despite apparent economic prosperity reflected in job numbers and stock market gains. The video argues that average Americans feel financially insecure due to a long-term downward trend in private sector income growth since the pre-pandemic era, leading them to delay or avoid starting families. Here are the key points discussed by financial analysts from EPB Research. Consumer confidence and real income. Consumer confidence remains weak because real income has significantly deviated from the pre-pandemic trend line. Real personal income, excluding government transfers, has fallen sharply, making Americans feel they are behind financially compared to their expectations from several years ago. Impact of government transfer payments. Short-term economic boosts from COVID stimulus payments masked deeper issues, as government transfers are not seen as a long-term sustainable income source. Once these payments ended, consumers were left to rely on their primary income sources, which did not keep pace with inflation. Historical income trends. From 1966 to 2008, real private sector income grew consistently at around 2.8%, but this trend broke after the 2008 financial crisis and again after the pandemic. Private sector real income is now $2.6 trillion lower than it would have been if the pre-2008 growth rate had continued. Birth rates as a confidence measure. The fertility rate in the U.S. has plummeted from 3.5 births per woman in 1960 to a record low of 1.6% today, reflecting widespread financial insecurity. The declining birth rate mirrors the consistent drop in private sector income gains, indicating a direct link between economic confidence and family planning decisions. The financial analyst from EPB Research made the following predictions. Continued decline in birth rates. As long as real private sector income remains suppressed and fails to recover to pre-2008 levels, the U.S. birth rate is likely to continue its downward trend. This will have long-term demographic and economic consequences, potentially leading to prolonged periods of economic stagnation and labor shortages. Long-term economic struggles. The video suggests that the private sector will continue to struggle to generate significant income gains due to increasing levels of debt and recurring economic shocks. Such economic conditions are expected to perpetuate feelings of financial insecurity among Americans, further impacting their economic behaviors and decisions. The overall thesis emphasizes the urgent need to address the income crisis that is dampening consumer confidence and leading to a significant drop in birth rates. The guest calls for a focus on sustainable income growth within the private sector. Additionally, the analyst hints at exploring policies targeting economic stability and reduced income inequality in future discussions. In today's video on Mott Capital's Market Chronicles, we're diving into a fascinating analysis of global market divergences and what they could mean for investors and the broader economy. Our host, Michael Kramer, a seasoned market strategist, will walk us through several peculiar observations in the financial markets. The core thesis of this video is that growing divergences between key global financial indices and spreads signal heightened market volatility and risk, which could indicate significant shifts in investor sentiment and potential market corrections. Michael Kramer presents detailed observations that showcase these divergences and suggests what they might mean for the future market behavior. Here are the key points discussed by Michael Kramer: divergence in volatility. between S&P 500 and Eurostoxx 50. Kramer observes a widening spread in implied volatility between the S&P 500 and the Eurostoxx 50. Typically, these indices move together, but recent trends show the Eurostoxx 50's volatility rising while the S&P 500's is flat. Credit spread differences. There is also a divergence between the iTraxx Crossover High Yield Index and the CDX High Yield Credit Spread Index. The iTraxx index moved higher while the CDX index declined, which is unusual as these typically trend together. European yield spreads. The French-German 10-year yield spread has widened, with French yields moving up while German yields remain flat. Italian yields have also increased, contributing to the widening spread. Risk-on and risk-off indicators. Currencies like the Mexican peso and Canadian dollar have strengthened despite a general risk-off sentiment in global markets. The Mexican central bank's decision not to cut rates has maintained the peso's high levels. Global stock indices, movements. The Eurostoxx 50, German DAX, and Hong Kong indices have shown signs of breaking down, contrasted by the S&P 500, which continues to climb, showing a clear divergence in performance. Specific market observations. The Chinese SSE Composite and CSI 300 had big moves up, but are now fading. Australia's market has been consolidating, and the Nikkei is attempting to break out of its trading range. Michael Kramer made the following predictions. Potential market correction. Kramer suggests that the current divergences could signal an impending market correction. Historical patterns show that such divergences can precede significant market movements. Michael Kramer concludes by emphasizing the importance of paying attention to these divergences as potential indicators of future market volatility and shifts. He advises investors to be cautious and watchful of impending changes in global markets due to the unusual trends and spreads observed. Welcome back to Eurodollar University. In this episode, we're diving into some startling revelations from one of the biggest names in retail, Walgreens. Today, we're joined by an insightful analysis courtesy of Jeff Snyder, Eurodollar University's chief strategist and a renowned expert in the field of global interbank markets and economic trends. With no apparent biases, Jeff brings us an eye-opening exploration into the reality of the U.S. economy, the retail sector, and job market intricacies. The core thesis of Jeff's discussion centers on the alarming signs from Walgreens and other major retailers indicating a weakening U.S. economy. This decline is further substantiated by decreasing consumer spending, faltering labor markets, and diminishing economic resilience despite contradicting positive payroll reports. Jeff argues that this economic malaise is reflective of broader systemic issues that traditional economic narratives have failed to address. Here are the key points discussed by Jeff Snyder. Consumer spending and retail struggles. Walgreens reports a staggering decline in consumer purchases, contradicting their forecasted second-half rebound. Levi Strauss and H&M echoed similar warnings about weakening consumer income and lower-than-expected sales. Gasoline demand, another critical economic indicator, continues to fall, pointing to lower consumer activity. Housing and economic data. Pending home sales in the U.S. sank to a record low, indicating a lack of consumer confidence in affording homes due to inflated prices and income uncertainties. Continued layoffs and a hiring freeze across various sectors highlight a stalling job market that doesn't align with positive payroll reports. Discrepancies in economic narratives. Despite mainstream assertions of a strong economy based on payroll reports, various economic indicators and corporate earnings reports suggest otherwise. Persistent income stagnation as prices soar from supply shocks means consumers are unable to regain their purchasing power. Jeff Snyder made the following predictions. No imminent economic rebound. Jeff predicts that, contrary to expectations, the second-half economic rebound is unlikely to materialize. Factors such as continuous consumer caution in spending and a stagnant job market are slated to exacerbate economic struggles. Further retail and household stress. Major retail chains might witness further stock declines and possibly store closures if consumer spending does not pick up. Energy demand, a critical economic barometer, is expected to remain weak, indicating persistent economic softening. Jeff Snyder wraps up with a sobering reminder that despite superficial economic narratives, deeper systemic issues persist. He's calling on viewers to critically evaluate economic conditions and not take mainstream reports at face value. With upcoming webinars and detailed analysis, Eurodollar University invites everyone to delve deeper into these critical economic insights and understand the real drivers of today's economic landscape. In these videos, various financial experts provide their unique insights into the pressing economic concerns. Danielle DiMartino Booth predicts a potential Fed rate cut in September due to rising unemployment and weakening housing markets. She also highlights risks within smaller banks facing stress tests. The host of Game of Trades notes that while economic indicators show downturn potential, the stock market defies expectations by climbing. At EPB Research, the analyst dives into the income crisis affecting birth rates and long-term economic stability. Michael Kramer points to global market divergences as a warning sign for future volatility. Finally, Jeff Snyder reveals alarming trends from major retailers like Walgreens, signaling declining consumer activity despite positive payroll reports. While there are varied viewpoints on the exact trajectory of the economy, all agree that significant risks loom, necessitating caution and adaptation in investment strategies. Stay tuned for ongoing analysis from these experts to navigate these volatile times. Thanks for watching Financial Analysis and Review for June 28th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.